we saw, obviously, the tech index and tech stocks sell off a lot. That's happening to those private sector companies too, where they're starting to burn cash and burn through those deposits. So everything I described was kind of magnified and exacerbated for the banks that we've seen fail so far.
With multiple high-profile banks failing as of late, a lot of people are wondering, is my bank going to fail? Or more importantly, is my money safe? Big questions like these are always better with really smart friends, so I thought I'd answer this one with my friend Meghan Rabuse once again. Meghan, also known as the Family Finance Mom, is the host of the popular Finance Explained podcast. Meghan is a former financial analyst, a mom of 3, and a regular guest expert to the marriage, kids, and money community. Welcome back to the show, Meghan.
Thanks, Andy. Thanks for the warm introduction.
Of course. Well, it's so good to see you again, and I know you're a busy PTO co-president, so I got to get you back to work. Let's talk about these important things and then get you back to the reality of life. So, Meghan, why are these banks failing in the first place?
Sure. So maybe, banks are kind of foreign concept to some people in terms of how they work behind the scenes. We go and put our money there, but then what happens to it after that? And so I think you kind of need to understand the basics of how a bank operates before we can then talk about why banks fail. So let's think back to the last couple of years where people were getting big stimulus checks from the government. They were getting expanded unemployment benefits. And in aggregate, disposable income across the country for people was higher than normal. Savings rates were higher than normal. And so because of that, you had big growth in bank deposits. And when I'm kind of giving you this data, I'm talking kind of economy-wide. So across all banks, they saw significant growth in deposits. At the same time, when banks get your deposits, the way a bank makes money is by taking your deposits and loaning it out at higher rates than what they pay you on your savings account. And then their profit, the money that they make and then use to run the bank, is known as the spread. It's the difference between what they pay you in interest on your savings account and what they can loan that money out and earn. Now, here's the problem. The same time that deposits were increasing really rapidly and all of us, our savings rates were really high, what were interest rates in the economy then? They were extremely low. Right? Mortgage rates were at all-time record lows, 3%, 4%. Interest rates on bonds were extremely low. And so banks put all that money to work at near record low interest rates. Now, fast forward, what has happened over the last year? Inflation got out of control. The Fed had to hike interest rates in order to combat inflation, but the banks already lent all that money out and locked themselves into earning interest rates that were much lower. And so what has also happened with inflation is that people have reduced their savings rates because they need to take out from their savings account in order to fund their everyday spending to keep pace with inflation, or because interest rates are higher, they have more attractive options other than leaving their money sitting in a savings account. They can go out and buy bonds themselves at higher interest rates, for example. And so at kind of the worst possible market timing, people's deposits are not only not growing, bank deposits are shrinking. And in order to fund those withdrawals to customers, the banks have to sell the assets that they invested in. And when they sell those assets at current market rates, they're losing cents on the dollar. The money that they were able to invest in treasury bonds when treasury bonds were paying 2%, to sell them today, they're not going to get, 100 cents on their dollar. They're having to sell them for 70 or 80 cents on the dollar, in the best case scenario. And so what happens is that really weakens a bank's balance sheet. And when that bank balance sheet gets weakened as they start to report that in the open market, whether it's during earnings season or whether it's because regulators give them a heads up and say, hey, your balance sheet is in trouble and we're giving you 48 hours to make an announcement yourself, or we're going to do it for you, which is kind of what happened in the case of Silicon Valley Bank. That sparks a run on the bank. It makes the bank's depositors concerned oh, hey, I may not be able to get all my money out. And so it almost becomes a self-fulfilling prophecy. So in a very condensed version, that is essentially what is happening in the world right now and for banks right now. And I want to be clear, like all banks are facing similar pressures in terms of rising interest rates and potentially having a mismatch in, I guess the best way to describe it is duration. So how long deposits are sitting and staying in place relative to how they invested those assets. Did they invest them in 10-year bonds and 30-year mortgages? Or did they invest them in 6-month treasury bonds where they're a little more liquid and they're going to have, less of a write down as interest rates rise? Really large banks that are very well established tend to be more diversified, both in terms of their deposit base as well as the things that they invest in. And presumably they have really smart people who are also kind of hedging them against these moves in interest rates. And I think what you saw happen in particular in the banks that have failed so far, there were additional risks like a concentrated customer base. So in the case of Silicon Valley Bank, you had a very, very concentrated customer base serving the, venture capital and high tech firms. And so all the things I described about growth and deposit rates were almost exacerbated to even kind of bubble levels where venture capitalists, when money was really cheap, had a lot of money to put to work. And so those companies got infused with a lot of cash during, call it like the 2020 era. And then as times got harder, we saw obviously the tech index and tech stocks sell off a lot. That's happening to those private sector companies too, where they're starting to burn cash and burn through those deposits. So everything I described was kind of magnified and exacerbated for the banks that we've seen fail so far. So let me pause there and give you a chance to kind of digest and if you have further questions there, but hopefully that makes sense.
Yeah, I love the explanation. It's very helpful as always. That's why I keep inviting you back. The question that I have that follows that then is what happens when a bank fails? How does that affect the economy? And then further from that, how does that affect everyday people like me and you?
Sure. So let me take the economy one first. When you have kind of a single bank failure, let's take, when first Silicon Valley Bank comes out and they are in trouble, a lot of people, I think, and rightfully so in many instances, said, hey, this is an isolated incident because of concentrated customer base, because of poor management, poor risk management. I know in one of kind of the data points that came out, like their risk management role was actually empty for like the last 18 months of the bank's operation. So there were definitely like operational failures isolated and specific to that bank. But now we've had more. And now there are more regional banks that are, selling off 30 and 40% in a single day because people are worried about what is kind of known as contagion. And it's kind of like almost sharks smelling blood in the water, where they don't want to be caught with their bank failure and their deposits tied up and not being able to get those out. And so what happens is that banks, in order to guard against that, start to tighten credit. So what does tighten credit mean? It means that they get much more strict about who they are willing to loan money to and at what rate and for how long. And so it's going to make credit more expensive, harder to get. And actually you saw yesterday, and not to get too technical, but in the FOMC statement from the Fed and the subsequent press conference where they talked about raising interest rates, you've heard them mention this as well, that credit is tightening, which is actually also helping them in reducing inflation. Because if it's harder to borrow money, there's less money in circulation, less money for people to spend, and that's going to help cool off demand and cool off inflation too. So that's kind of the big picture, like what is the economic impact of this across the economy?
So macroeconomically, this is kind of a good thing?
Kind of a good thing. Yeah. It doesn't feel so good if you're a small business owner trying to take out a loan. It doesn't feel so good if you're a first-time home buyer who's been saving, trying to buy your first home, and now you need a higher credit rate, or you're going to have to pay a higher interest rate, even if you have a higher credit rate. But in the big picture, grand scheme of things, it's actually not the worst thing for the economy because it is helping us kind of correct this inflationary struggle that we've been battling. Now, at the individual level, and I think this is really important for people to understand, and this dates back to legislation that was put in place during the Great Depression back in the 1930s when there were a series of runs on banks where literally the federal government shut down all the banks in the country to be able to review them individually and say, this one's safe, this one's not. They created something known as FDIC insurance. It is federal deposit insurance that is banks pay premiums into FDIC protection. And in the event that a bank fails, every depositor, and this is by depositor name, so associated with your social security number. So if you're a small business, you are accounted for separately than if you had like a personal account. Every depositor at a bank is insured up to $250,000. So in the event that you were at a bank that failed, the FDIC, what happens is state regulators come in, they close the bank, they turn it over to the FDIC to run and operate, and the FDIC makes sure that you are whole on your deposits up to $250,000. So that number is really important to understand. And for everyday individual people, they may think like, well, that seems like a whole lot of money. My money is going to be safe anywhere. But think a little bigger than that in terms of like, if you're a small or medium-sized business owner, biweekly payroll could be more than $250,000. And so as you get to a little bit higher net worth, as you get to, a smaller or a little bit bigger business, that limit can be a little concerning. So it is important to understand, like, is my bank healthy? Is my bank safe? Especially if you are managing assets that start to kind of exceed those limits.
Yeah. Well, let's talk to the person who's listening right now, and maybe they're at a regional bank and they're thinking, I'm going to pull my assets and go to a bigger, more solidified bank. What would you say to that person?
I mean, I don't fault them for feeling that way. I think I want to be very fair and clear in that not all regional banks are going to fail. Right now, there are ETF indices that track regional banks. Right now, the KRE is one of the most common ones. It's down about 6-7% year to date. Look at some of the banks that failed. Those banks were down 60%. Like some of the others this week in the aftermath of First Reserve Bank that got shuttered and taken over by the FDIC and sold to JP Morgan over the weekend. Some of the others that are in trouble are like PacWest, I think is now down 60-70%. You'll notice that a lot of these are on the West Coast and share some of the tech customer concentration risk that Silicon Valley Bank shared as well. Those are some of the ones that people are most concerned about. But when I'm talking about this, I'm talking about what is their share price performance? Because individual investors collectively as a whole are a pretty smart bunch. They're tracking these companies' SEC filings. They're examining their balance sheets. And if their stock is selling off to a significant degree, it's because they have cause for concern. So if you were at a regional bank, pull up their ticker symbol online, type it in, what is their year-to-date stock market performance? Now know this, all banks are facing this rising interest rate risk, this pressure on spreads where they're going to have to pay you more interest. They may have assets that are getting written down because they were invested at lower interest rates. All banks are facing that. But the degree to which they've managed that risk and the impact of that on their individual balance sheet is going to show in their share price performance. And for the people who say, you know what, I don't even want to worry about it, I just want to be at a bigger bank. I mean, that's a very real reality right now. And you're seeing that play out in the stock market too. So like the JP Morgans, the Bank of Americas, the Wells Fargos, I don't want to leave. And there's kind of a handful of like big national banks. All of them are up or even maybe down single digits year to date. Whereas the regional banks are down like 30% year to date. And then the ones that are really struggling are down, their stock prices are, some of them in case at risk of going to zero. Those are the ones where you might want to be like, yeah, I don't think I want to keep my money here anymore.
Sure. Yeah. And at the end of the day, if your balances are below that $250,000 mark, know that your money is going to be safe.
That's correct. And so in the case of, for example, First Reserve Bank, they were acquired over the weekend by JP Morgan. The FDIC is making guarantees to JP Morgan on certain of kind of their, if you want to call them toxic assets or more risky assets. And so now you're part of JP Morgan Chase, their retail bank is Chase typically, even if you didn't move your money there, that's where it is now. And it's, in good hands. But, those are, I think, the key things as individuals to understand, but also to kind of understand what's going on in the broader economy and why this is happening.
Absolutely. Well, Megan, we appreciate your time today talking to us about this pretty serious subject about what's going on here in 2023 and beyond. It's good to know how these conversations play out for your personal finances. And I know you do that on the weekly basis over at Family Finance Mom and Finance Explained. So tell people where they can connect with you and learn more from you, just like you helped us learn today.
Yes. So you can find me every day over on Instagram at Family Finance Mom. Twice a week, I host live Q&A where I take questions directly from individuals, and they can be market related, economics related, or, even just like personal finance that's applicable to you. I do that for about half an hour twice a week. Those replays you can catch on my podcast, Finance Explained, along with, I have guests on various topics that are kind of in the headlines and relevant to people as well. So come on over and check me out, and feel free to ask questions as they occur to you.
Absolutely. She's an open book, just like we were today, asking her a bunch of pressing questions. So you could do that over on Instagram live. She does them live, as well as this great podcast, Finance Explained. Megan, thank you so much for your time today. I appreciate it.
Thanks, Sandy.